Okay, so on to question 4. Question 4 says the equipment had an estimated useful life of 6 years and no residual value when purchased. Compute the book value of the equipment at January 31st after the proper January adjustment is recorded. Now, the adjustment that needs to be made when it comes to equipment is depreciation. That's the adjustment that we do every period end when it relates to long-term assets. The way we calculate depreciation, so far in the course you've only learned one way, which is called the straight line method, and the formula is as follows: cost less salvage over useful life. And this machine, if we look at our trial balance, cost is $14,400. There was no residual value, and it's good for 6 years they gave us all of this information in the question. So that told us that we're allowed to be calculating $2,400 of depreciation every year. But we're only talking about the month of January, so we only need monthly depreciation. So if depreciation per year is supposed to be $2,400, and there's 12 months in a year, well, that would tell us that we're allowed to calculate $200 of depreciation every month. So that tells us how much depreciation we need to be claiming this month. Just for those of you who don't know, what would normally happen in a company is once you know how much depreciation you're going to claim, you would do the following journal entry. You would increase depreciation expense by $200, and you would credit accumulated depreciation, which is actually known as a contra asset account, which is also increasing accumulated depreciation by $200. But what they're actually asking us in this question is they're asking us what's the net book value of equipment. And net book value is whatever the asset account is. So in this case, the asset is called equipment, less any associated accumulated depreciation. Well, it's sitting at $14,400, the machine. We already found that in our trial balance. And its associated accumulated depreciation, it says accumulated depreciation equipment, is sitting at $5,000. And we just added another $200 to it. So it's sitting at $5,200. So the net book value would be $14,400 less $5,200, the accumulated depreciation, leaving you with a net book value of $9,200. And that answer that matches that is answer A.